Hello, everyone, and a really enthusiastic welcome to this brand new explainer right here on the GAAP Advisors Ind AS Clinic YouTube channel. I am so thrilled you're tuning in today because we are about to completely dismantle a massive accounting myth that has been confusing financial professionals and investors alike. We're talking about mirror accounting in the context of common control business combinations. Now, I know it sounds dense, but I promise you, by the end of this explainer, you're going to see exactly how these numbers play out and why getting this right is absolutely critical for financial transparency. Okay, let's dive into this. Here is our agenda for today. First, welcome to Ind AS Clinic, followed by the mirror accounting dilemma, Ind AS versus mirror accounting, court schemes and auditor duties, the group perspective, and finally, deep dive and next steps. Section 1. Welcome to Ind AS Clinic, ground rules and disclaimers. Before we get into the technical weeds of today's case study, we just need to set up the structural foundation of this explainer. Think of it as laying the groundwork so that everything we build on top of it makes perfect sense. To ensure absolute clarity as we look at the numbers today, let's establish our parameters. For our purposes, the beginning of the reporting period is always the 1st of April, and the end of the reporting period is on the 31st of March. Furthermore, our functional currency and presentation currency is the Indian rupee. This means any currency other than our functional currency will simply be treated as a foreign currency. Pretty straightforward, but essential to keep in mind. Also, just a quick but very important note, the views expressed here are the personal views of the author and are not binding on the audience. Please remember that you should always seek the help of a qualified expert before taking any action or refraining from any action based on the views we discussed today. Now, you might be wondering, why should you, any person investing their hard-earned money in shares of a listed company, actually care about these complex accounting standards? Well, the answer is simple. It's about protection. Understanding these strict rules is precisely what protects your hard-earned money from financial illusions and clever bookkeeping tricks. When you know the rules, you can read the real story behind the numbers. And if you really want to protect yourself and deepen your knowledge, make sure you connect to the GAAP Advisors Ind AS Clinic podcast on Spotify, Amazon, or YouTube for deep dives into issues exactly like the one we are dealing with in this explainer. Section 2. The Mirror Accounting Dilemma, the case study. Today's case study actually comes directly from the 213th edition of the GAAP Advisors Task Weekly newsletter, authored by CA Manish C. Iyer, Director at GAAP Advisors, and published on LinkedIn. Let's move to the specifics and see how this builds. Imagine a scenario with two companies. Step 1, X Limited decides to sell off its retail business. Step 2, who buys it? Well, Y Limited, which just happens to be the parent company of X Limited. Step 3, because Y is the parent of X, this entire transaction is happening under what we call common control. They are essentially part of the same corporate family. So let's look at the cash. On the disposal of this retail business, X Limited receives a total consideration of exactly 200 rupees. Just keep that number in your head for a second. 200 rupees is what X Limited gets in its pocket. But here is where it gets interesting. Against that 200 rupees received, the actual book value of the net assets that X Limited disposed of was only 150 rupees. And this brilliantly illustrates our dilemma. 200 rupees received minus the 150 rupee book value leaves us with a difference of exactly 50 rupees. So X Limited has a gain of 50 rupees on this sale. The real suspense here is entirely about where this 50 rupees actually belongs on the financial statements. When the parent company, Y Limited, acquired these assets, they recognized them at cost, and they parked the difference as a negative capital reserve. So the central question for the subsidiary, X Limited, is this. In their standalone financial statements, how should they recognize that 50 rupee gain? Since Y Limited recorded it in a capital reserve, should X Limited just mirror that parent accounting and throw the 50 rupees directly into a capital reserve too, completely bypassing the profit or loss statement? I mean, it kind of sounds logical, right? Just do what the parent does. Section 3. Ind AS versus mirror accounting. The verdict on the 50 rupee gain. Well, logic and accounting standards don't always hold hands in the way you might expect. So the crucial point is summarized perfectly by this quote directly from the source material. The concept of mirror accounting is conceptually baseless. Boom. That completely debunks the myth right there. There is literally no such thing as simply copying the counterparty's accounting treatment just because it feels symmetrical. In the individual financial statements of X Limited, that gain of 50 rupees absolutely must be recognized in profit or loss. Why? Because Ind AS dictates specific treatments for specific entities based on their individual positions. In fact, if you look at Ind AS 109 regarding financial instruments or Ind AS 116 regarding leases, you'll see clearly that mirror accounting fails miserably. The accounting for a lessee is very different from a lessor. Therefore, X Limited must follow the rules for the derecognition of assets and take that 50 rupee gain straight to P&L, no exceptions. Section 4. Court schemes and auditor duties, no immunity from Ind AS. But what happens when companies try to get clever with the legal system? What if this whole common control transaction was done through a court scheme, and the scheme explicitly stated that the gain should be charged directly to reserves and surplus? Does a court order grant you immunity from Ind AS requirements? The answer is a resounding no. Doing a transaction through a court scheme does not change the requirements of Ind AS. Ind AS 8 is very clear. When a standard applies to a transaction, the policy must be determined by that standard, period. In fact, it is the other way around. Auditors have a strict duty to certify that a court scheme actually complies with Ind AS. If a scheme tries to hide a gain in reserves instead of P&L, the auditor must refrain from certifying it. Navigating these complexities is exactly why finance professionals and auditors rely heavily on resources like the issue repository at gapadvisors.com. That platform hosts over 4,500 issues and their responses regarding Indian accounting standards and Indian GAAP. Any person can register for free and submit their specific issues to get a detailed response delivered directly to the inbox of the email registered with gapadvisors.com. This is an incredibly useful tool, especially for auditors who need bulletproof documentation on how they addressed any issue relating to the application of Ind AS.
Section 5, the group perspective, zooming out.
Now let's broaden our lens a bit. From a consolidated, group-wide perspective, there is actually no change in assets or liabilities, which means there's no change in equity. The 200 rupee consideration essentially just moved from one pocket to another and remains entirely within the X Limited group. Because the cash hasn't left the group, it cannot be accounted for as a dividend distribution to Y Limited. Instead, from the separate financial statements perspective of the parent, this acquisition is treated as a business combination under common control, and the parent accounts for it using Appendix C of Ind AS 103, recognizing the difference in a capital reserve. That's for the parent, but as we just learned, the subsidiary still books the gain in P&L. Section 6. Deep dive and next steps. Connecting the dots. Wow, we've covered a lot of ground today, dismantling a very stubborn myth and wrapping up our technical analysis. If you found this breakdown helpful, here is what you should do next. First, if you are registered on LinkedIn, subscribe for free to the Task Weekly newsletter by C.A. Manish C. Iyer. To date, there are over 230 incredibly detailed editions published. Second, if you have specific Ind AS or IFRS issues you're wrestling with, you can easily book a one-on-one consultation directly with the author from his page on topmate.io. Third, don't forget to connect to the GAAP Advisors Ind AS Clinic podcast on Spotify, Amazon, or YouTube for deep dives into issues like this. And lastly, a huge thank you for your time today. I highly request that you hit that like button, add your thoughts in the comments, and subscribe to the GAAP Advisors Ind AS Clinic channel if you haven't already. Please share this explainer among your contacts, colleagues, audit and finance teams, and students pursuing their CA course to help spread the knowledge of Indian accounting standards. I want to leave you with this final provocative thought. Can a company really afford to hide gains, potentially avoiding tax liabilities, simply by hiding behind the completely baseless garb of mirror accounting or common control? As we've seen today, the rules of Ind AS are clear, strict, and designed to show the true financial picture. Trying to sidestep them isn't just bad accounting, it's a massive risk. Keep asking the tough questions, keep looking closely at the numbers, and I will see you on the next explainer.